Hi. Okay, so I wanted to make a video specifically addressing the pay-as-you-earn option for an income-driven repayment plan for grads paying back student loans versus the income-based repayment. So the P-A-Y-E, pay-as-you-earn versus income-based repayment or IBR. And the reason I wanted to make a video about it is because I think that there is a lot of information available on the internet to grad students trying to decide between the two plans, undergrad students as well, to students that have graduated, trying to decide between the two plans. But I think that a lot of times those articles, at least the ones that I can find, really only take into consideration the short term. And I think that not thinking about the long term is one of the reasons that these federal loan servicing companies and the government make so much money sometimes off of students. And so I wanted to really thoroughly go through these two plans, define some terms, and make sure that everything makes sense. Because it took me a really solid day of piecing together the information, making sure that I wasn't signing myself up for something that would really benefit me for 5 years, but then like 15 years later it would be terrible, all those things. And so I feel much more empowered now. I feel like I have a really good understanding of what's going on, all things considered. And so I wanted to make a video about it. I will share first and foremost that I am not a financial advisor of any sort, so take all of this with a grain of salt and know that this is my personal evaluation of what's going on, and take what you will from it, all things considered. I will also take this time to say that I do think this is going to be a really long video, and I recognize that. So I'm gonna make a table of contents in the description, so if you would rather skip some of this stuff, hopefully you can find what you're looking for in that table of contents. I will also say that I made a script, so if you catch me looking over there, so I can make sure that I am touching on every bullet point that I wanted to touch on, because there is so much to unpack here. Okay, so why don't we start with the big question, how do I qualify? Qualifying for income-based repayment or for the pay-as-you-earn plans are both the same. What you have to do is demonstrate partial financial hardship. And that means that at the time that you enter either the income-based repayment plan or the pay-as-you-earned, the annual amount that you would be paying on the standard 10-year plan is more than 15% is the number of your discretionary income. So what also needs to be defined there is, what is your discretionary income? Discretionary income is defined the same for both plans. It's the amount of your adjusted gross income that exceeds 150% of the poverty line. So let's make all of that make sense. Okay, I think that an example that we can really hold on to will be super helpful. Getting out a pen and paper, this is really old school, but I don't really know how to make videos, so here we go. Let's say we know that the federal income poverty level is about, I believe, 12,000, and this is for a one-person household. So this is assuming that you are not married, essentially, okay? And so 150% of 12,000 equals, I need a new pen, 150% of 12,000 equals 18,000. So what is your discretionary income? Let's say that your adjusted gross income is 60,000. That means that your discretionary income, which equals your adjusted gross income minus 150% of the poverty line, would be 60,000 minus 18,000, which in this example would be $42,000, okay? If you have $42,000 of discretionary income, that would mean that in order to demonstrate partial financial hardship, which again means that the annual amount on the 10-year standard plan would be greater than 15% of your discretionary income. So then in this example, that would mean 15% of 42,000 equals 6,300. Okay? So all this means is that if you add up your monthly payments on the standard plan and that number is greater than 6,300, then you demonstrate partial financial hardship. So in this example, 6,300 divided by 12 months in a year is 525. So if I needed to pay more than $525 a month on that standard plan when I first applied to either income-based or pay-as-you-earn, I would be demonstrating partial financial hardship. So the next really big question after you understand whether or not you qualify by demonstrating partial financial hardship is, what's my monthly payment going to be? So the rules for both IBR and pay-as-you-earn are the same so long as you are a new borrower. And a new borrower means that you didn't owe any money on any federal student loan as of October 1st, 2007, and you received a disbursement of a direct loan on or after October 1st of 2011. So if you meet both of those qualifiers, then you are considered a new borrower, and pay-as-you-earn and both IBR are going to yield the same monthly payments. If you don't qualify, then there's a little bit of a difference, and I'll explain it. If you are a new borrower, then essentially your monthly payments are calculated by taking 10% of your discretionary income and dividing it by 12, so that annually you pay no more than 10% of your discretionary income. If you are not a new borrower, then pay-as-you-earn is going to be 10% of your discretionary income, but the income-based repayment is going to be 15% of your discretionary income. So assuming that you are a new borrower, let's look back at that first example that we used, okay? Again, we're back here where we were before, and we recall that if $12,000 is the federal poverty line for a one-person household, then 150% of 12,000 is 18,000. And if I'm making an adjusted gross income of $60,000 a year, then my discretionary income is that $60,000 or adjusted gross income minus 150% of the poverty level, which is $18,000, okay? Which means again that my discretionary income is that $42,000 mark. So 10% of 42,000 is 4,200, and then 4,200 divided by 12 equals 350. So if I'm a new borrower, that means that I'm going to be owing, give or take, around $350 a month on either plan. The other good news is that both plans are going to cap your monthly payments so long as you continue to qualify, so that your monthly payment will never be more than the monthly payment that you would have owed on the original standard 10-year plan when you first enter the plan. So next big question is which loans are eligible, and this is different per each plan. So for the income-based repayment, or the IBR, you have got direct loans as well as FFEL loans. So direct loans include direct subsidized and unsubsidized loans, direct plus loans, and direct consolidation loans. Whereas the FFEL, which stands for Federal Family Education Loans, these include federal subsidized and unsubsidized Stafford loans, federal plus loans, federal consolidation loans, and federal supplemental loans for students. Okay, so if you have any of those loans, you're going to qualify for the income-based repayment. Now, if you want to qualify for pay as you earn, the only loans that qualify are direct loans. That means that if you have FFEL loans, you are going to have to consolidate them into a direct consolidation loan in order to qualify for pay as you earn, which is something to consider because if you're going to qualify out of these, which we'll talk about in a second, but if you're going to qualify out, you want to consider whether or not you actually want to consolidate loans, especially if a big chunk of your loans are those FFEL, but we'll get there. So those are the loans that are eligible. And then the other big question, of course, and I think one of the reasons that pay as you earn and IBR are both so tempting as new grads is that there's loan forgiveness. And for the pay as you earn, it's a 20-year period, but you have to qualify for all 20 years. So we're going to talk about that. But for pay as you earn, you're forgiven after 20 years. For income-based repayment, if you are paying off undergraduate loans, you're going to be forgiven in 20 years. If you're paying off graduate loans, you're going to be forgiven in 25. So it depends on what kind of schooling you're paying for. Also, you are going to be taxed in either situation on whatever is forgiven. So if you get $10,000 of your loans forgiven, you are going to be taxed on that. So that's something to consider, but you can plan for it if you're going to qualify for 20 to 25 years. So here we've reached the point where I feel like most of the information that I just provided is pretty readily available on the internet. There are some wonderful websites that will give you tables and calculators, and you can enter in your loans and you can see your monthly payments and you can see how much will be forgiven, which is great. Again, the short-term benefits look phenomenal. It's a good weight off your shoulders, etc. But I don't see a lot of websites or articles asking the big question, which is, are you going to qualify for income-based repayment for 20 to 25 years? Or for pay as you earn for 20 years. So what I wanted to lay out is some really important questions to ask yourself before applying for either plan and then only paying off what you owe every month. The really big question is, will you qualify for income-based repayment or pay as you earn for the next 20 to 25 years, pending what kind of loans you have? That is the big question. And hey, life happens and it's really hard to guarantee that you know for sure whether or not you're going to qualify, and I totally hear that. But I think that that's the most important question, because if you won't qualify for the whole time, then your loans won't be forgiven. And so what I've devised are a couple of bullet points to go through to encourage you thinking about the right things that are kind of a little bit easier to guesstimate that might really affect whether or not you're going to qualify. Number one, you have to reapply for pay as you earn or income-based repayment every year. You have to recertify and you have to prove that you still demonstrate partial financial hardship, okay? If you don't apply on time, your interest is going to get capitalized. And that is something that we have to consider. So when your interest gets capitalized, that means that however much interest you have on a loan, let's say you have a $100,000 loan, 6% interest rate, okay? That means every year you're paying $6,000 on the loan. let's say for a whole year you don't have to pay anything on it, and you don't. And so at the end of the year, the principal balance is the same. It's still $100,000, but now you have $6,000 in interest. If that interest gets capitalized, you now owe $106,000, and the interest is going to be on that number instead of the original $100,000, okay? So if you miss the recertification period and you don't get it in on time, then your interest is going to capitalize. If you no longer qualify for partial financial hardship, your interest is going to be capitalized. And if you leave the plan for any other reason, then your interest is going to be capitalized. Okay, so those are really important things to keep in mind. So now let's talk about those. What could cause your interest to be capitalized? One, you no longer demonstrate partial financial hardship. So what could that look like? Let's talk about it. So something big to consider is, do I think that I'm going to get married? We're going to go down both paths of life and talk about how it could affect you and how to do the math regardless of what you think. But let's first go down the path of, so you're not going to get married. Let's do the math, okay? All right, so in this example, let's say that you have that $100,000 loan. Okay, so we'll write that's your principal balance, and you have a 6% interest rate. Let's say that when you entered either IBR or pay as you earn, you were that household of one, right? It's just you when you entered. And then when you entered repayment, if you had done that standard 10-year plan, then you would have owed around $1,110 per month on the loan, okay? So that big question that we're asking right now is, how much money could you make before you qualified out of partial financial hardship? So let's recall, partial financial hardship means that on that standard 10-year repayment plan, the amount that you would owe annually is more than 15% of your discretionary income, right? And discretionary income, again, is defined the same for both plans. It's the amount of your adjusted gross income that exceeds 150% of the poverty line. Okay? So let's go back to what we know. We know that the federal poverty line for a one-person household is around $12,000. So we know that 150% of $12,000 is $18,000. So that's what we're going to subtract from our adjusted gross income to figure out our discretionary income. And if we owe $110 per month on the standard plan, well, that means that we owe $13,320 per year. And so the big question, and the easy way to set this up in a fraction if you want to, is that you're looking for 15% equaling 13,320. And so the fraction there is that 15 over 100 equals 13,320 over a magic X number. And then if you cross multiply and solve it, if $88,800 is your discretionary income, then you still need to add that $18,000. And that means that our magic number for your total income is $106,000. So that means that if you think in the next 20 to 25 years, you might make $106,000 a year, then you are going to qualify out of income-based repayment and or pay as you earn, and you won't get forgiven. So if you do think that marriage is in your future, then you have something kind of different to consider. If you and your spouse choose to file your taxes jointly, which most married couples do because of the tax benefits that you can get, then your monthly payment is going to be based off of your dual income and dual debt. So let's use that same example that we were just using. You have a $100,000 loan at a 6% interest rate, which means that that magic number on the 10-year standard plan when you entered repayment is still $1,110 per month. Now you're a household of two, which means that your discretionary income, or the definition of your discretionary income, is going to change a little bit. We know that for a household of one, that federal poverty line is that $12,000 mark. For a household of two, that line is closer to $16,500, give or take. So now the way we want to do our math, the way we want to add things up, is we want to say, okay, if my income doesn't change at all, and I'm still making that 60 grand that we talked about in the very, very first example, well then how much can my spouse make before we qualify out of pay-as-you-earn or income-based repayment? This example is going to assume that your spouse does not have debt. If your spouse has debt, that's going to change this a little bit. But still, important things to consider. So blast from the past, this is the exact same example that we were just using. $100,000 as the principal, 6% interest rate, and remember that standard 10-year plan is going to be about $1,110 per month, which is about $13,320 per year. But now, big difference, we are a household of two, which means that the definition of discretionary income is going to change. And so now, like I said, that federal level, that federal poverty level for a household of two is going to be closer to $16,500. 150% of $16,500 is closer to 25 grand. So if you circle back to our old math, we already know that that 15% marker that we're looking for discretionary income, we know that $13,320 is 15% of $88,800. If you have $88,800 of discretionary income and you're a household of two, that means that you make about 25 grand more than that. So we need to add that 25 grand. So that means the two of you together can't be making more than $13,800. So let's minus your $60,000 that you're making a year. This would mean that your spouse can't make more than about $53,800 per year, or you are going to qualify out of the income-based repayment and pay-as-you-earn, and you won't get forgiven. So let's circle back to the most important concept when it comes to considering income-based repayment and pay-as-you-earn plans. And that, again, is capitalized interest, which one more time is just a fancy way of saying that whatever interest you have on your principal balance is going to get added to your principal balance, and then you will owe interest on your interest. Let me walk you through one more math problem, why it is so important that you figure out whether or not you are going to qualify for this plan for 20 to 25 years, okay? So let's rewind and let's use the example that we have been using time and time and time again. You have a principal balance of $100,000, 6% interest rate on that $100,000 loan. You are making 60 grand a year, and we already know, we've already done the math, you qualify for partial financial hardship, which is wonderful. And that means that you can qualify for income-based repayment or pay-as-you-earn. Here's the catch. We've already done the math. We know that if I'm making 60 grand a year, I'm going to owe about $350 a month on my loans. $350 a month is about $4,200 a year. 350 times 12, $4,200. $4,200 a year that I'm paying on my loans. But I have a 6% interest rate on a $100,000 loan. That means that I'm accruing $6,000 worth of interest every year. So effectively, by only paying what I owe every month, I am only paying $4,200 on my interest, which means I'm going to get $1,800 a year in interest that I'm not going to touch. Let's say you qualify for income-based repayment or pay-as-you-earn for 10 years and you never pay more than what you owe. So you're 10 years into one of these plans. You've only paid what you owe every year. That means that you have $18,000 worth of interest that's accumulated over the 10 years that you haven't touched. If on the 11th year you no longer demonstrate partial financial hardship and you no longer qualify, that $18,000 of interest is going to capitalize onto your $100,000 loan. So now here you are, 10 years later, with a $118,000 loan at a 6% interest rate. You've been paying $350 a month for 10 years, which is effectively over $40,000. It's $42,000. I did the math. It's effectively $42,000, and you're back at square one 10 years later. That's why it's so important to go through these thought experiments and figure out whether or not you're going to qualify for the whole 20 to 25 year amount of time before you get forgiven. Because if you don't think you're going to qualify, you need to adjust the way that you look at your monthly payments and pay them in that mindset. So let's talk that through. Everything being said, the income-based repayment and the pay-as-you-earn are really wonderful options from a credit perspective because they keep your debt-to-income ratio very, very reasonable. And here's the thing with debt-to-income ratios. If I owe $350 on a loan, but I want to pay $700 on it a month, that doesn't affect my debt-to-income ratio because I don't owe $700 a month. I am just choosing to pay $700 a month or $400 a month or however much more a month than what I actually owe. So here are my parting words of wisdom and ultimately what I chose to do with my loan. I think I'm going to qualify out in the next 20 to 25 years for income-based repayment or the pay-as-you-earn option. And since I think I'm going to qualify out, I still want to apply for income-based or pay-as-you-earn because I want that debt-to-income ratio to stay golden. But I'm going to do the math on my loans. I'm going to figure out if I have a $100,000 loan at a 6% interest rate, that means that annually I owe 6%. $6,000. That's 6% of $100,000. If I divide 6,000 by 12, I'm going to get 500. So now I know I need to pay at least 500 a month, even if I only owe 350, to keep my interest at bay, so that later, if I qualify out, at least I'll only owe my principal balance and not suffer from capitalized interest. So I need to pay at least that 500 number to make sure that I don't get in lots of trouble later. If you aren't going to qualify out in the next 20 to 25 years, then pay-as-you-earn and income-based repayment are phenomenal options for you, and arguably the pay-as-you-earn is the better one. So if you don't think that you are going to qualify out, pay-as-you-earn is the one to go for. If you do think you might qualify out and you have to consolidate to get on pay-as-you-earn, I actually think that the income-based repayment is a better option because you can do your math and say, okay, I know I need to pay this much money per month in order to not get my interest to bite me in the butt later. And if I didn't consolidate, then I can choose to pay on my highest interest loan every month. I can choose extra on it. Really long video. Thanks for watching all the way through. As a parting note, I really enjoy finances. I want to be very, very clear again. I do not have a degree in finance. I am not a financial consultant. These are just my personal views on the matter. That being said, if anyone has other questions about this sort of thing, ask in the comments. I might make another video. Like I said, I really enjoy this stuff and I think it's fun to learn about. And I think that it's really important that we feel empowered instead of scared, because I think that that fear drives us to make decisions that are really, really tempting and make a lot of sense for the next 2 to 3 years, but don't make the most sense for the next 20 to 30. And it can be really hard to think that far ahead in the future, and I totally hear that. But I think it's important, and I think that future you will be happy that you did. So that's that. I hope that you guys have a wonderful rest of your day. I hope that this was helpful. And hopefully I will see you again for another video. Okay, bye.